All right, this is another segment of Plan B A plus setup. Still explaining more further on the point of interest. All right. So point of interest, you have understood that that's the place you want to pay attention to find a market entry. Now we've taken time to discuss about CRT and all of that. And then all of these things actually interwoven. And if you understand them, it will be easier for you. I'm going to be taking FVG, MSS. So these are basically ICT concept or something, but I'm not going into ICT and all of that, trying to sell to you, a explanation about most important thing that you need to look out for, finding an entry into the market. So FEG, MSS, Fibonacci retracement, other blocks. So of course, FEG and other blocks work hand in hand. So I'm not going to all those details. And then so how you actually meet them. So the next episode I'm going to be teaching about, all right, chart patterns, not necessarily that, but the divergence, talking about divergence and of course chart patterns. So, but this time around, I'm going to be blending FEG, MSS, Fibonacci retracement, and other block. Now, all the time I'm going to be talking about market maker models. Now that's swing sweep. And then of course, every day I wake up, I have to take a session sweep. Oh, sorry, daily sweep, that's timing sweep. And so we have just say sweeps. You say sweeps. So these three things can be combined to one liquidity sweep. So liquidity sweep, we have different sweep region, daily, timely, sessions, and market maker models. All right, so now let's go into the detail. So I'm going to open a chart. So FVG, I've told you what FVG is formed by three candles where there is inefficiency, all right, in the market. So it's expected that the market probably should return back there and react. So market structure shift is done when there's going to be a practical turning point, towards another direction. And of course, all of these are built on price action. That's why we say this concept of Plan B, Felix hybrid price actions, resistance and support strategy. Okay, so now let's go. Now, if you are not in my community, if you are in my community, of course, this document, you will have access to it. It's posted. So if you want to have access to it, so I'm not selling it. If you will be on my forum, Felix in our code, you can have access to it. So FEG, MSS, Fibonacci retracement, and other blocks. So let's look at chart. You can pick any chart. So this is gold. I actually enter a market here, and I will show you very simple. You may see some of my color I painted left and right. So I'm taking them off so that we can start all over. I've told you about the power of three and then CRT and how it's been used. One of the lovely things that all of these things have combinations in their usage if you have better understanding of them, and that's going to help you a lot. Okay. So now, first we said you must establish the fact that market either is a downtrend or an uptrend. And if that is established, practically speaking, then you can know what to do next. But I'm going to be talking more of fair value gap, other blocks, market structure shift, and Fibonacci retracement. So how do I go about this concept and what's it all about? I'm not trying to do conceptualization, just tell you raw how they are. I've told you it's a three combinations of candles that form FVG. Okay, example, these are an FVG. This is a candlestick and a long one created, which is here, and then another third one. So the first one, the second one, and the third one. So FEG is formed by three candles. 1, 2, 3. Now, the gap between the 1 and 3 was created by the 2. That's what we mean by FEG. So if you look at it, how do I now use it? So I'm not going detail about that, but just to spot it. How do I spot and use them? Now you can see that this is a kind of bearish FEG. Now, but if the market is an uptrend, so it's a bullish market. Now, what you may spot as a bearish FVG may not work, all right? So you now have what we call FVG invasion, right? So, but let's don't go into those, just for you to spot. Now, normally, when you want to spot FVG more properly, I would advise you go with a higher time frame. So if you go with a higher time frame, it's going to make a lot of sense for you. Go with a higher time frame, it's going to make a lot of sense for you. So now let me go to 4 hours. So this is 4 hours of GBP USD. So it's obvious that this market is a downtrend, right? Okay, so if it's a downtrend, let's go. So what I do, I just establish the fact that the market is a downtrend or an uptrend. So if it's established, fine. So if it's a downtrend, the next thing you want to find out is that is there any fair value gap somewhere that the market can return back to mitigate, and that will form your entry. That's what we call it point of interest. Look at this market, probably when the market got here. Look at it. This is an FVG. So now certain things need to play out for you, right? This is another FVG here to this point. Now you can see that this has not been filled. So at any point in time when you see market travel then react, you wouldn't know why. So this is an FVG. And the higher time frame FVG make more sense, okay? So this is an FVG. Then this is an FVG. Can you see now? So let me just stretch it out. Okay, that's an FVG. So we have two combinations here of 4 hours for that matter. Look at it from here to here. It's an FVG. Okay, can you see now? Gap left behind. Now, so if you will confirm that the market is a downtrend, then you want to look for a point of interest based on fair value gap. Now, what is another block? Another block is a point of counter movement, a candle countering the last candle, all right, moving towards a direction before the counter one. Example, look at it. This candle here, this green candle. So this is the last green candle before a major move against the trend. That is the other block. So that means this whole candle from the high to the low of this candle is another block. Are you seeing something now? Now, if I'm mapping all of this, there is another block. Now, this fair value gap have been mitigated. Now, so as the market was going down, what happened? It left. Now we have another block, and then a fair value gap was created. Okay, a fair value gap was created. There are multiples of it here. Then this major one. So that means what we're expecting is that, is it going to happen now? Is it a certainty that it must happen now? So you have to understand that no, it's not a certainty. Okay, it's not a certainty that it must happen now. So, but you are having awareness that okay, where is likely market to travel back to? That's what you are looking for. So when the market was selling, right? So it has created a fair value gap here. So you expect the market, and now this whole body here, look at this whole green candle is another block. And you can see that other block happened inside the fair value gap that was mitigated. Fine. So the market sold down massively, and then the market continued to move, right? Another block was created here, but it was immediately mitigated, even if it was partly mitigated. Then the market sold down. Okay. Then you have another. This is another block. Probably may not understand. This is another block. Now another fair value gap is created here. So just understand all of this. Now, when the market recover, market continue to move massively. One of the things that you need to pay attention to is that how the market run into those points are very important. If it's slowly, not that means it's just inducing and accumulating more liquidity now to act. So you need a smart move in and out of a certain offset region, all of that. Yeah, so this market, I was in a drawdown because I was busy and I entered this market. I was on a drawdown of about $200. Yes, you hear me right? About $200. But I will now show you how was I able to just hold myself. Not to, yes, I was a drawdown of 200 and something dollars. Now it's back. If I allow, I'll just close everything and then have my rest. Okay, so now here we go. This is another block. So you can fix it out. Now, so the market need to travel into that. I like the other block to be filled properly before actually I will find an entry. So the market has traveled back up here. Look at it, a massive move. Now you are happy for this. So this was filled completely. So because other block with, all right, the fair value gap, they are more stronger and powerful. All right. So here you have, this is another block. That is a bearish order block. So this is a bearish order block. All of these are fair value gap. So you do just jump in because it has hit the fair value gap. No, you still expect certain thing, which is called the market structure shift, MSS. Now, but the market travel back to this point. Make a lot of sense, right? So when the market travel back to this point, so you are now thinking that, okay, I need to now wake up and check to lower time frame to see market structure shift. So if you look at it, the market continue and up to this point. So I have to use more recent data so that we can get proper analysis. So let me use Bitcoin now. Sorry, gold. So here is gold on 4-hour time frame. So, but gold is becoming normal, abnormal, supernormal because you may not get what we are looking for properly and all of that. Okay, I have to be checking on this so that I will not cut it off. I will not sleep with that after the market has recovered to an extent. Now, so let's look at it. I want to look at the recent data. Okay, so let me use Euro USD or probably still same. So now recent data. So you look at Euro USD, you know that it's a downtrend. So if it's a downtrend, very simple, right? This is a downtrend. On 4-hour time frame, it's a downtrend. This is a high, this is a low, this is a high, this is a low, this is a high. Now you know I love marking my key levels. Okay, this is a high. Now I think it creates another, okay, this is a low. And then a new high created and it's now dumping now. Sorry, because since I'm teaching, I don't want to be carried away. I don't want to be carried away, but this is the time for me to actually smash plenty money. But I really need to help myself. You understand? I need to help myself so that I know that because all of these points are liquidity areas, so you can sweep this one and decide to go down. Because I think I even saw it as a Asia high somewhere there. So if you sweep it, they decide to start dumping. So I wouldn't want a situation I'm under pressure. So that's why I want to do what I want to do. See what I want to do now to be safe. You know, trading is about protect capital, secure profit, and trade with profit. Okay, so in order to continue, so you can imagine this now. In order to continue what I'm doing properly, I just close it. So if I want to close, just take my money. Okay, this is what I'll do. I'm going to close partial close and put very insignificant. So I go here and then I put 0.02. Close that one. Okay, because this is the first thing I need to first do. Trail my stop loss to this entry. That is 4,035 something. 4,035. So I'm just little above the entry. So then what can I do now? I'll click on partial close. So I can close 0.02. All right. So I close it. So I've closed this now and then left little fractions. So no matter what the market wants to do, I'm protected now. Okay, so now let's turn back to our, so it's still part of trading and learning, okay? So I was talking about the Euro USD, that invariably, you know that it's a bearish market, both for your 1 hour or 4 hours. Now, so what am I going to do if I'm trading with this? Okay, I've seen a high, low, a high, low. So as at the excuse me, as at the time you came, you have seen high, low, high, low, high, low, right? So let's go this way. Now, from here, so this candle here, look at this candle here. This candle, this last bullish candle before an aggressive move is another block. On top of it, this green, this what's called the negative candle, that is the bearish candle. The beginning of that bearish candle that caused the move to start going down. The candle that initiates the move is a supply zone. So if I'm going to mark the supply zone, that means the whole candle or the wick of that candle, the bearish candle, or the whole candle. So similar to the whole candle, the last bullish candle, all right, when the market now turned bearish, is your other block. So the first bearish candle, all right, that form, of course, side by side with the last bullish candle before the bearish begin, is your demand supply zone. So that means altogether here we have both demand zone and supply zone. So get it quick, right? So now what happened next? What happened next is a very strong order block should be order block that market have an impulsive move away from. After that move away, you need to have a fair value gap. That is, there was a hurriedly movement from that region. So now if you look at it here, I have this is a fair value gap, and it now combines to this massive, big and wide fair value gap. Are you seeing it now? So now this is fair value gap. This is order block. So the market continue. So of course, just like a minor pullback, and then massive sell. After this sells, so what you are looking for is that this market, okay, this market should come back to that fair value gap. Why? The book was not balanced, was not completed. Now, good enough, you that you are trading, you already have your key levels marked, and of course, this alignment. So what we want to see is that the market need to travel back up to that fair value gap. But take note, the fair value gap may not fully necessarily be filled at the time. That's one of the things people missed out of the trade. So here we go. The market has traveled back here. It creates another high here and a low, and then sweep of liquidity and then mitigation. These are fantastic signal entry. So, but that's not an issue. Just to show you how the fair value gap and how market could travel that. Now, and I talk about Fibonacci retracement. Now, Fibonacci retracement is used in this way in a trending market, and you have to identify the trend. And so you understand the swing, either the swing high, swing low, or swing low, swing high. What do I mean by swing high, swing low? Where did the market stopped? This is a swing. Where the market stopped is a swing, right? And then what do I want to have? Is this market going to even turn ordinarily? So if I want to measure my Fibonacci, this is immediate swing high and immediate swing low. Am I envisaging that the market is going to be selling? Maybe yes. Okay, so that is to say, I have gotten the high and the low. So the market now got here. So when I get the high and the low, where I expect the market to start reacting from is from 38 to 61. But a very powerful market should be at least above 50 Fibonacci retracement level, the 0.5. Now, so if the market react from above, so here, this is where they call this guy golden zone. So if the market come in between 50 and 61, it's a golden zone. All right. And then you want to take market from there. All right. But this is the thing. These guys have a fair value gap that was mitigated by this candle. Then sell down massively. So you want the market to return here. So the market actually returned to this point, and then at least from 38 you want to see proper reaction. And I'm going to show you what is the proper reaction. We have so many things. Now, that's why I first thought about the power of three and then the candle rate theory. It could be candle rate theory that you find there, all right? It could be candle rate theory you find there, and it could be, what's it called? It could be candle rate theory you find there, or, market structure shift. So FVG, I've showed you how we identified it. Next is the other block. I've shown you how it is. So we said the market came here, form another block. Now, I'm going to show the refinement of that entry. Here, the market. Now, but for me to actually measure a swing high, swing low, number one, here was a previous swing low. So the moment the market break this point, so I'm interested. So this swing low, marry this swing low, swing high. Now, the moment is broken, a new swing low created. But will I just take this swing low immediately? No, I'm going to show you something. Pay attention to this detail. Now, here we have a swing high and a swing low. But this swing high is a lower high to this one. Now, that means this is already strengthened. This one can still be wiped off, which is called liquidity sweep, because it's a swing high. Market can return back, double into it, and push down. So you understand that. Okay, so now if that's the case, now we go down. We move here, a break of structure has happened. Then the next I want to do, where is the likely point of me entering this market again? I pick from this swing high to this swing low. Anything Fibonacci, you take from left to the right. You take from left to the right. Now see something very importantly. On 4 hours, you have seen that the market returned back. Now, this is your 38. Market still have very strong strength. 50 make a lot of sense. Look at 50 to 60 to 61. Some people said they are trade at a limit order. Okay, so some do that. So, but I don't do that. I watch my trade and execute my action. So now here is 61. The market ought to have stopped here. So sometimes you are stopped out because you don't wait. Now, because ordinarily when you set your Fibonacci retracement, if you like, you enter at 50 or 60 or 38. Your stop loss will be above 78. That means if it crosses above 78, the market is invalidated. So in case you like to just set it and go away, that's what you're going to do. So here, the market. Now, you ask me questions. What happened? The market got to 50 and 61. Why did it not retrace? We have fair value gap left. So three things that work together here with very lovely setup. Let me show you three things that work together here. Number one, my weekly key level. The market traveled to my weekly key level and got rejected. Number one. Number two, then it comes to mitigate the fair value gap. Make a lot of sense. So that means this is a very A+ setup. By the time I refine it, it's going to be a massive one. But if you didn't mark it, you won't know what the market was actually reacting to there. Very fantastic, right? Good. Now, let's go. We have this as another market. So now the market has been broken, the market structure broken. Then we are going to take the Fibonacci again from this, the highest of this, to this lows where the market start returning from. Now, you always wait for the candle, for a candle to close and create another one towards the negative direction. So you won't, because this market now, look at this candle just close and all of that. Once it close and then the new one start coming and start pushing out, you have to now invalidate it. So we come here. So look at what you are now expecting for a proper sell. For a proper sell, you look at, you now mark your Fibonacci. So let's mark my Fibonacci from, right, 38 to 61. That's this block here. Now let me take it off and show you something now. There's a confluence here. What's the confluence? We're having a fair value gap. Where is the fair value gap? Look at it. So where is the last candle? This is the last candle, this small one. That is another block. Another block inside a key level. So let's look at it. This is another block. This last bullish candle. That's your bearish order block, number one. Number two, we now have fair value gap. From where? See the combination of your fair value gap here. From here to here. Look at this. So no matter what this market is doing, it's either I didn't find a trade or I find a trade. You know what I mean by that? It's either I do not find a trade or I find a trade. Not finding a trade is that I don't want to take any nearly but never kill a bird. Until the market get to that point, that means I didn't find a trade. If I find a trade, it's a trade. If I do not find a trade, I didn't find a trade. Meaning that the market could get here anyway, because this is another key level, and start selling. But I was not there to take trade. It's not a problem. So you can't take all trades. Okay. So here we come. The market continue, right? The market continue. So, and it's doing all what it's doing here. It's not my business. So that means I do not have a trade here. So I want the market to return here, or else market start creating a change of direction, which is a different thing altogether. So, but what I'm waiting for is that the market need to travel back up to this point. This is another block. This is the Fibonacci 38. At the center will be 50. At the up will be 61. Okay. So that means inside this block is a very fantastic setup that I'm patiently waiting for. So if I wait for this to happen, if it didn't happen today, that means I do not have a trade on this instrument for today. Do you understand? So the market, when it returned back to this point, so I'm looking for a change of character, market structure shift, but I need it to aggressively enter into this. And so if you look at it, if you enter to here, it may just reject at this point. I'm looking for a way to find an entry. So that's where you now do what we call refinement. So I'm showing us, so order block, all right, FVG, fair value gap, right, and then the Fibonacci retracement, how to actually use it. So usually when you are using in combinations, they are very fantastic. Are you getting it now? They are very fantastic, and it will be optimum for your trade. That's what I'm talking about, A plus setup and all of that. So let's check if we can find an instrument that's going to be similar to what we have just explained. Okay. So I was telling us about the gold. Okay, so in the same vein, you can use 1 hour. So don't get it twisted that I only use 4 hours. No, you can use 1 hour. So 1 hour is good and all of that, so you can use it. But sometimes if you are not seeing what you are looking for properly, if you look at this now, using 1 hour is going to confuse me so much. I will be in and out of the market. So go for 4 hours. Make a lot of sense. Okay. Now, so I was telling us what I did here. And if you watch the previous video, you're going to see that I was talking here. Now, this is a bullish market on gold. This is an uptrend. So this is an uptrend. So get it right, okay? This is an uptrend. So now the market is doing what it's doing, no problem, right? And I told you that when I come to the market, I do one thing, but I check and all of that. So, but that's not the time now. So we're looking at one, we're looking at order block. Two, we're looking at order block. Two, we're looking at fair value gap. Three, we're looking at market structure shift, and then we're looking at Fibonacci. These 4 things. So now, but of course, this is not out of your market structure and trend. If you don't understand trend, I'm sorry, that's going to be a problem for you. Okay, so let's go. Here is it. The market is up and down, up and down. So I need to identify the trend. So now these are not trend. So this is a high, this is a low. All of these are not high. So because this is higher than this. So the next high is this and another low here. Okay? Okay. So because when you want to now enter, as the market was now doing this will have been my entry. So here to this high. And look at my entry here. Marvelous, right? This is why I love Fibonacci trade. A trending market shouldn't give you problem if you know what you are doing. But if you do not know what you are doing, you are going to cause problem for yourself. So 1 hour, I just allow the market to travel back completely, and then I'm switching. So that means this is the previous high, and then this is the previous low. So what are we now looking for? Now, very simple. What we're looking for, you can see gold. I told you I was selling part of it, and I have trailed my stop loss to entry. So the least can do to me is to exit and lose nothing. So trading is secure capital, protect capital, secure profit, trade with profit. So assuming I left it, by now I will be struggling again to go back to see what happened. Now, so let's go. This is a low. And so when the market got here, okay, you have not gotten a high, right? So if you take it, if you take your Fibonacci retracement from here to here, I think you could find a trade. So you could find a trade at 61, right? Now, so let's take out this. So what do we find here? There is a small fair value gap. Train your eye to see it, okay? Don't rush anything. Take your time. There's a fair value gap here. Are you getting it down? You see that? There's a fair value gap here. This is another block. I hope you are getting familiarizing yourself with all of those. Don't cram them, so you don't need to cram them. You're not writing exams with them. Right? So this is a fair value gap. Oh my God. See, there's so lot of things. So when you understand this at a glance, you enjoy it. Now, let me show you something. Let me show you something. Even before, of course, when you use this place, of course, when you use this place, let me show you three major confluences that happen here, which I'm not supposed to be bothering myself about. Okay, this is a right. This is a low, right? And then we took it to this point, and it came to 61. Fine. Now, at a glance, on that 61, let me show you one thing I just saw. I now see candle range theory here and power of three. Look at the last bearish candle. The last bearish candle, oh God, it's good to understand something. Now, the last bearish candle, look at it here. If you have marked it, and that the last bearish candle is what formed the other block. Now, if that was what formed the other block, very simple, right? Then what happened? We now have the candle that sweep the liquidity and close here. I told you that some persons in their 1 hour, once this candle closes here, they entered the market straight away. Put it this way. And their stop loss at where? At the low of the candle that manipulate the market. That's 120 pips. So where is their take profit? At the high of where the market came from. That's 1:2 instantly. So 120 to 250 pips. You heard me right? Massive. Okay. So that's one of the things. Now, so you have a lot of confluences here. Remember what I'm teaching you is other block. Fair value gap. But you see how those things blend together because you have the understanding. That is massive. Now let's go this way. So we have this now. Okay. So we have this and the market move again. So if the market has moved that way, the last low, you can see the last low. Let's take out this. So you can see the last low is this. And this creates a high. So let's take Fibonacci retracement. Are you seeing it now? So this is the last low because here it's taken out. So now this is the last low. Okay. Because if we go by this, let's see here. Okay, you didn't find any measurement. So this is the last low, last high. So now you've gotten all of this. Now let's go. 38, remember, to 61. Fantastic, right? All right, let's take the Fibonacci off. So now there are fantastic things that happen here. This is a fair value gap that was mitigated if you were following when the market was going up, partially mitigated. Then we have an unmitigated fair value gap, very freshly baked. Nothing happened to it. The guy was fresh, and that's this guy here. Can you see that? That's this guy here. This is a fair value gap, and this is 1 hour time frame. This is a fair value gap. Make a lot of sense, right? Inside the Fibonacci retracement, but below, right? Below 50% Fibonacci retracement level. Now that makes a lot of sense. Anything below 50 That's a discount price. So you prefer to buy at a discount price than a premium. So look at the fair value gap. It's below 50. It's inside 61. So it's below 50. Retracement level is inside 61. That makes it an optimum. Very optimum. So now let's go. Very simple, right? So the market you're looking for is this fair value gap. And there is another block here. This candle opposing. So now let's go. So what you are doing is you are patiently waiting for the market to come back here. All right? You are patiently waiting for the market to travel back here. Very simple. Okay. Now the market has come back here. So let's take off all of this so that I'll show you something. Now, market has traveled back here. So let me enclose these ones on this one so that we can do something. Now, I go back to 5 minutes. The question you asked me, Felix, what are you doing in 5 minutes? I want to refine the market to find appropriate entry. Sometimes your refinement will be good, sometimes will not be good. So I go to even 1 minute to see my refinement faster. I think I did that. So this is now called MSS. What do I call it? MSS, market structure shift. So you don't just jump in, but you want to do your due diligence so that you can have what we call sniper entry. So market has traveled inside this place. Make a lot of sense. So this is a low, this is a high, right? Another high, but internal liquidity. So we have the lowest. Then we have a recent high. So this recent high need to be taken out. Once this recent high is taken out, okay, you are looking for a pullback from this. If you didn't pull and leave it, you take out this high and eventually took out this high. Remember, this is a low. Okay, this is a low, this is a high, this is a low, this is a high. So this is a new low. So both were taken out. That's massively good. So patience is required of you. You wait for the market to pull back. This is not a pullback. So where do you want the market to pull back to? In fact, it didn't pull back to where you want it to come back to because there's a fair value gap here. There are a series of them here. Some were mitigated, but these two guys were not mitigated. Okay, I think you are still in order. Let's take it down this way. Can you see now? So there is order block here. This is 1 minute. And then there's fair value gap here. Now, I enter my own fair value gap in 3 dimensions. You know, this is your market. And so I divide into 3. Since this is my fair value gap, I divide into 3. One portion in here, second portion at the middle, third portion at the close. My stop loss, this is the long candle that caused that fair value gap. So my stop loss will be below it. And obviously, is the low of the period. So that's where my stop loss will be. So now let's look at it very quickly. You now take a trade. One is here. 1:2 risk reward, or you could add targeting any of this high. 1:2 risk reward. Okay, I say your stop loss must be below, let's say, yeah, it must be below this guy. So 1:2 risk reward. Let's see how it's going to go. 1:2 risk reward, or sometimes you are targeting this high. So 1:2 risk reward is already done. Okay. Then, of course, you have another position that you put on higher, more time and all of that. So, but what now really happened here? That's why I say monitoring your trade on a one single entry or market and all of that instrument is good. Now, the market has gone up and came down again. Remember, it came down again to properly mitigate. You know, this is a fair value gap. Properly mitigate the fair value gap. No problem. See your, oh God. How many of us will see something? Because you have found an entry, right? See what happened. You can tell me what really happened here. Your first order closed the profit. Your second order was not triggered. Your third order was not triggered. Then what happened to them here now? What happened to them here? Now, the second and the third well triggered. Your stop loss is still below here. And then the market continued. So now, that is to say, now, so if this one was, you know, I set one in 1:2 risk reward. I set another one, no profit taking, because I want to trail or higher. Okay, maybe 1:3. Then the other one, no take profit. So that means as it is, they all triggered. The market was moving and all of that. So now let's go back to 5 minutes. It is when you didn't see your refinement in 1 minute, you go to 5 minutes and all of that. So let's go this way now. So 1:3, almost 1:4 were trigger. Look at this high you're targeting. Okay, so almost that was triggered here. Then there we go. Other market, the third one, still in that same dimension. So the market was moving on. And then look at this liquidity area that the market didn't get to react. Now, if you look at it here now on 5 minutes, we have a fair value gap here. So that could be what was mitigated there that made the market turn down. Look at it. So if you're a scalper, this will have been your own selling. You will be selling from here because that is a fair value gap. Okay. So let's return back to 15 minutes. Returning back to 15 minutes, you can see the fair value gap properly too. Let's go this way. Can you see that? So now, what I try to show to us on my 1 hour time frame, so I've shown you the MSS, market structure shift, right? Then let's go. The market has done this is a major pullback, right? Just pull back to the, I think the other fair value gap. I wouldn't know what this one pull back to, but just when you were in higher time frame, you could see what happened and all of that. Market pullback, that should be another entry for you. Okay, then we'll go back to the 1 hour. Okay, so this is how fair value gap, order block, then Fibonacci retracement. Now, if you now understand the power of 3 and then the CRT candle range theory, then this is another entry which I've shown in the candle range training. So I may not go too much detail on that now here, because that will have formed a confluence for you here. And what's the confluence here? The confluence is this. This is accumulation, manipulation, and so I told you that most traders, once they close and close, they enter their stop loss below this candle. So whatever that is happening here, this person is still in this trade. So we have conservative, patient traders that know their owners, they are not fidgeting and all of that. That will have formed another one. Now, if you look at another power of 3 or candle range, this range, this one manipulated, then close of this here is another entry. All right. So, and when you get your entry, you are in profit. I always tell, especially if it's in gold, you take the profit. All right. So these are the things that I have to try to explain to us so that we can understand what we're doing per time. So basically, fair value gap, market structure shift, Fibonacci retracement, order blocks. They are very powerful, stuff you need to understand. Okay. And I think I just need to have a break, and I'm going to come back to show you the aspect of all right, the sweep, liquidity sweep at timely sweep and swing sweep, right? Then along with divergence. So using indicator to identify divergence will be the next episode I'm going to be giving to you. So pay attention, stay calm. You are not part of our community, then come and then get engaged and let us show you the way out, right? So go to the comment section. Links are there for you to register on capitalxtend. That's the broker we use for Forex, and then register on Deriv Synthetics or WellTrade, or both of them. That's what we use for synthetic trading. You want to be part of our swing trade, futures swing trading. We use CoinW. The link is equally there. Then if you want to use trading bot to trade your future in scalping mode and all of that, all the links to are available. Bekenet software is a powerful tool that we use to trade the market as seamlessly possible. So you want to get access to it, the link is equally down there. Thank you very much, and do have a nice time. The next episode is to teach you on divergence and other related pure point of interest for trading. Thank you.